What is up, guys? Raymond here with another financial statement analysis video. This is going to be episode 2 in our financial statement analysis videos for the German industrial stocks. This company is called BASF. I'm not sure how to pronounce that correctly. BASF, maybe a short for a larger term. But let's get into the key ratios. If you're new to my financial statement analysis videos, what we do is indicative of the title. We analyze the top financial or most important financial statements relevant to a company, those being the income statement, the balance sheet, and the cash flow statement. We look at each key factor of each financial statement, and we attempt to get a picture of the overall strength of the company, as well as its financial future and its financial viability in the future. So without further ado, we're going to start with the key ratios, which are separate from the financial statement. The market cap is 39.88 billion euros, which is very large, which is also very good for shareholders. That purely can be an attractive point for shareholders. For some people, it is one of the most important factors of a company's key ratios. The revenue figure, which is the overall sales of the company in the last financial year, was 78.6 billion euros, which is amazing. The only issue I have is the large disparity between the market cap, which is the overall price of the company, so how much the company is selling for. So if you wanted to buy if you're a prospective shareholder and you're interested in buying the entire company, the company will cost 39.88 billion euros, give or take a few billion euros for transaction costs, etc. But the company's total revenue for 1 year, which is the total sales, how much it's managed to sell in one particular year, was 78.6 billion euros. So the company managed to sell in one financial year almost twice what the company is worth. So that is quite scary. So 7.83% is the current dividend yield, which is amazing. We always say that, I always say anyway, that a good starting point for dividend yield, or a minimum threshold for a minimum amount or minimum percentage for a company to pay out, should be around 5% if the company is classified as a dividend stock, or if a stock is classified as a dividend stock, should be 5%. This particular company issues 7.83%, which is really good. It also may be a reflection of the company's share price decreasing quite significantly, which could also be a connection to why the market cap is such a low figure compared to the revenue figure. But I doubt any dip in price of the stock can justify such a large disparity between the market cap and the revenue, but we'll check anyway. So the company managed to decrease its share price by 34%, which is quite a significant amount, but then again, we are in a period of economic instability, whereby almost all companies, almost all stocks are having trouble with regards to increasing their stock price. Almost all stocks have reduced their stock price by quite a significant amount. So 34% is actually quite small compared to, for example, the Netflixes that have decreased their stock price by over 60%. So yeah, so 7.83 is still good nonetheless. It's still a very good percentage of dividends to pay to shareholders. So I guess a lot of prospective investors will definitely be interested in investing in this company. So the PE ratio, which is the overall price of each share, which currently stands at 43 euros, is divided by the earnings, which is the overall net income, divided by the amount of shares outstanding. So the overall shares outstanding, for example, if it's 1 million shares that the company BASF has outstanding to the general public, if you get the earnings, so the net income for the current period, which in this case is around 10 billion euros. If you divide 10 billion euros by 1 million shares, you get 10. So the earnings per share would be 10 euros. And if you get the price of each of the share, which is 43, so if you get 43 divided by 10, it should be 4.3. So the price to earnings ratio will be 4.3, but in this case it's 6.64, which is actually pretty good. It shows the overall expensiveness in the best way to describe it. It shows the overall priciness of each share. And if you look at it in another way, the each unit of the price to earnings, each unit of the price to earnings ratio represents a year of time that it will take for a shareholder to retrieve his a return, sorry, retrieve a return on a return of investment, or return, yeah, a return of investment or a return of capital with regards to gains, if the company managed to maintain its current financial output. So if it managed to maintain its revenue at the current period adjusted for inflation, and it managed to maintain the dividend yield and other financial output figures, then the company managed to sustain its market cap or overall price at a steady period, as at a steady rate. The shareholder would expect to receive his return, receive his capital, or at least a return of capital, in about 6.64 years. So the earnings per share, which is the what we calculated before in the P/E ratio, is the earnings. So the overall net income divided by the shares outstanding is 6.554 euros. The beta, which is the overall risk level of the company or the stock, is 1.33, which is really good. The overall average of a stock should be 1, so it's about 33% over the average. That's actually considerably better than the previous stock we analyzed, Airbus, which was 1.79, uh, which had a beta of 1.79. So this is about 33% over the market average of risk of volatility. So let's get into the income statement, which is the first of the financial statements we're going to look at. So as you can see, there's quite a bit of inconsistency with regards to the not only the revenue figure, which is a light purple figure, and the net income figure, which is a dark purple figure. But we're seeing a good level of positivity with net income compared compared to the last stock that we analyzed, Airbus, which had 2 years which were negative in profit. So this is definitely good. With regards to net income growth, revenue growth, the company managed to decrease its revenue from 2019 to 2020, by quite a small figure, not by much, but it managed to increase its revenue figure from 2020 to 2021 by quite a significant factor, almost 30%. So we're going to check the net income, which was quite significant in 2019. It was around, I would say, about 10 billion euros. And in 2020, it managed to have a negative income, but by less than 1 billion, so not by too much. And the 2021 financial year managed to increase its revenue figure by, as we said earlier, about 30%. And it also managed to increase its net income to about 20 billion euros. Sorry, not about 20, so about 8 billion euros, which is good. So let's check the balance sheet. The balance sheet depicts the overall debt of the company, the overall liability of the company, which is the dark purple figure, compared to the overall compared to the overall assets of the company, which is the light purple figure. So the overall assets of the company seems to consistently be around 50% or around 50% higher than the liabilities of the company, which is really good. It shows that the company is managing to produce quite a significant profit, as well as sell, as well as to have a high level of sales without being over leveraged, without borrowing too much from outside sources. So it's definitely very good. Let's check the cash flow statement to see how the company is managing its cash as well as its debt. So the company managed to, in 2021, it managed to generate 5.52 billion euros of net income, which is very good. And with regards to cash flow from operating activities, was 7.24 billion euros, and investing activities was negative 2.62 billion euros. Cash flow from how it managed to get to that figure was by expending 3.53 billion euros on capital expenditures, so enlarging the company's capital base. The cash flow from financing activities was 6.46 billion euros, which is very good, especially because they managed to dish out 3.03 billion euros in dividends to shareholders, and it also managed to get rid of 3.15 billion euros worth of debt, which is really good. It managed to also clean off the interest associated with that 3.15 billion euros. So in the future, if the company manages to stay steady and maintain its current economic output, it will be able to have a higher net profit, simply because a lot of net profit or piece of the net profit won't be going towards interest on the 3.15 billion euros managed to repay. So the net change in cash was the ending figure, which also depicts how much cash the company has in its accounts. Was 1.71 billion euros negative. So the company still has a negative cash figure, which isn't very good. But it has over 50% an over 50% um, um, advantage of its assets over its liabilities. So it definitely isn't in an economically tough situation to repay its debts, or at least to be able to cover its cash. But it may be exposed to capital adequacy risk due to its negative cash balance. So let's check the 2020 financial year. 1.88 billion euros the company had as cash in its accounts, and 2019 the company had a negative 64 million euro cash balance. So without further ado, I'm going to close this video. Thank you guys for watching. I will see you in the next one.